Hello my dear students. So hope all of you has written very well the CA Inter Advanced Accounting paper. So I came up with the analysis on the question paper. So these are the MCQ answers. First A, second MCQ C, third D, fourth C, fifth bit B, sixth B, 7A, 8C, 9C, 10D, 11th A, 12C, 13B, 14C, 15th B. So these are the answers. So see, I have solved very quickly and maybe by making some assumptions here and there. So these answers, according to my point of view, and maybe there may be slight changes. So but these are the answers. Mostly they will stick into. So let us quickly dive into the questions and let us start discussing the answers. First MCQs. AB contractors undertake a fixed price contract of 350 lakhs. Information relating to the contract is given. This question is relating to A7, and in this question they are asking what will be the profit or loss on the contract overall. So this is a fixed price contract. Materials purchased 125, labor charges 95, unused material 22. So we should not consider unused materials 22. Estimated future cost to be incurred for completion of the contract 115. Payment received as a part of the payment 50 lakhs. Nothing to do with the profit or loss. And machinery used for 4 years for the contract. Original cost of the machine is 210 lakhs. Expected life of the machinery is 20 lakhs. So therefore, what will be the profit or loss on the contract? So materials purchased 125, labor cost 95, unused materials 22. We should not consider it because it is not utilized. So therefore 125 plus 95 minus 22, it will be 198. And the depreciation of the contract machinery 210 lakhs divided by 20 years, and this machinery is used for this contract 4 years, so 42 lakhs. So 198 plus 42, it will be total 240 lakhs. This is the cost incurred so far. And what is the estimated cost of the contract, sir? The estimated cost of the contract is 115. So therefore 340 plus 115, it will be 455. Sorry, not 240 plus 115, it will be 355. So 355 is the total cost including the estimated cost, but the contract price is only 350 lakhs. 350 lakhs. So therefore, what is the loss, sir? Foreseeable loss 5 lakhs. So 5 lakhs is the overall loss of the contract, sir. So the answer is A. Loss of the contract 5 lakhs. Or see, you can see traditional way, here, what is the percentage of completion? Cost incurred till date 240, total estimated cost 355. So 240 divided by 355, so 67.60. So approximately 67.60% is completed. So from 355, 67.60, it will be around 240 lakhs again. So 240 lakhs is the current year revenue. Cost incurred is also 240. So therefore, only here the foreseeable loss, that is the excess 5 lakhs, is considered as loss of the contract. So that's we have considered. And come to the second bit. Second bit is relating to accounting standard 16, sir. Very simple. ACE Limited borrowed 25 lakhs from ABN Bank during the financial year 23-24. ACE Limited used these funds to invest in equity shares of K Limited. So they used these funds for investment in K Limited. So they made investments. K Limited implementing a new project. So with these future prospects, ACE Limited invested 25 lakhs in K Limited. Okay. As on 31st March 2024, since the said project was not complete, the directors of ACE Limited capitalized the interest on the loan amounting to 2 lakhs and thus added to the amount of interest to the cost of investment, market value of the investments given. Sir, first of all, sir, whether investment in equity shares will become a qualifying asset. To become a qualifying asset, it must take substantial period of time to get trading for its intended use or sale. Here we are directly investing in the shares of the company, so that itself is an asset. So it is not become a qualifying asset. So therefore you cannot add interest to the cost of the asset. See, according to A16, borrowing cost, interest will be added to the qualifying asset only if it is directly related to the acquisition, construction, production of qualifying asset. Here investment in equity shares is not a qualifying asset, therefore they cannot do this. So what is they are asking? Identify the correct answer. Okay, let us identify the correct answer here. So first, interest paid is acquisition charges, hence directors of the ACE Limited correctly added to the interest cost. Wrong. They cannot add interest to the cost of investment. Since project is qualifying asset, directors of the ACE Limited correctly added. No, it is not a qualifying asset. See, they are implementing a new project, but we invested in the equity shares. So ACE Limited invested in equity shares, which is not a qualifying asset. Therefore, directors are wrong to add the interest in cost of investment. Rather, it should be charged to P&L account. I think C is the correct answer, right? And the last one, since project is a qualifying asset, directors of ACE Limited should capitalize the interest amount. No, not. So therefore, C is the correct answer, sir. Very simple question. Now come to case scenario 1, sir. The following summary cash account has been extracted from the Next Space Limited accounting records. I already solved this question, sir. See here, literally cash book given, sir. What they're asking, what would be the value of cash flow from financing activities? So you know what is financing activities? Any inflows and outflows relating to borrowings and share capital. So in the inflows, see which items are relating to the investing financing activities. Cash sales, no, it is operating activity. Trade receivables inflows, operating activity. Rent, investment activity. Income tax refund, operating activity. Loan from bank, so it is financing activity. Issue of shares, financing activity. Sale of investment, investing activity. So these two are financing activities as far as the inflows is concerned. Now coming to the outflows, trade payables, operating activity, office and selling expenses, operating activity, trade commission, operating activity, underwriting commission, generally commission you pay at the time of issue of shares. So this is financing activity. And then redemption of preference shares, financing activity, brokerage and sale of investment, investing activity, interest on long-term borrowings, so it's a financing activity, payment for overheads, operating activity, purchase of goodwill, investing activity. That's it. So therefore now they're asking what is the financing activities. So financing activities 5 lakhs plus 2 lakh 50, that is 7 lakh 50,000 inflow. And what are the outflows in the financing activity? Minus 25,000, minus 8 lakhs, minus 85,600. So the answer is 1,60,600. So 1,60,600. So you add all the inflows minus outflows, you will get a net outflow of 1,60,600. Next, which of the following could be considered as cash flow item from an investing activity? What is this investing activity here? Underwriting commission, no, it is relating to shares, so it is a financing activity. Trade commission, operating activity, it is not. Purchase of goodwill, yes, it's an investing activity. So the answer is C. So C is the answer. Next, what would be the value of cash flow from operating activities? Very simple, we already identified. What is the operating activities here? See here, cash sales 15 lakh 56,000, this one 7 lakh 40,000, and these two are inflows, 15 lakh 56,000, 7 lakh 40,000, and also refund of income tax is also operating activity, these two. And as far as the outflows is concerned, 19 lakh 60,000, 1 lakh 20,000, 40,500, and also one more thing, 46,000. So therefore inflows and outflows, operating activities. So inflows 1, 2, income tax refund 3. These three are inflows as far as the operating activity is concerned. Trade payables, office and selling expenses, trade commission, and then payment for overheads. 4 outflows. So you minus it. So you will get the answer of 1,54,500. So this is the answer, B bit. So next, what would be the value of cash flow from investing activities? Very simple. What are the investing activities here? So see the investing activity. As far as the inflows is concerned, rent from property held as investment 64,000, and also sale of investment 49,500. So 2 inflows. As far as the outflows is concerned in investing activity, brokerage and sale of investment 9,200. Only one, and purchase of goodwill. This is also investing activity 50,000. So 9,200 this one. So therefore, so investing activity, 1 second sir, investing activity, so 64,000 plus 49,500, 1,13,500 inflows sir. And as far as the outflows is concerned in investing activity, brokerage on sale of investment minus 9,200 and minus 50,000. So I think it is 54,300 sir, 54,300. So 54,300, A is the answer sir, correct answer. Maybe I think I have not considered this 50,000 in my original answer, so I think 6th bit A is the correct answer, not this one. So in the beginning you can update. Sixth bit, A is the correct answer, sir. A is the right answer. Okay. So very simple, but very simple answer. Not a great deal. Once you need to identify the inflows and outflows of cash. Okay. Now see the seventh one. Glow Limited had taken a loan of 5 lakhs in June 2023. This loan is to be repaid in 10 half yearly equal installments starting from December 23. Determine how the remaining loan will be classified in the balance sheet as on 31st March 2024 as per Schedule 3. This is one of the very simple questions, sir. Actually, loan taken on June 2023 and it is paid in 10 installments, sir. So every 6 months, one installment starting from December 2023. So first installment is paid on December 23. December 23. Second installment June 2024. Therefore, in between 31st March 2024 came. So by the time 31st March 2024, 9 installments still remaining, right? Out of the 9 installments, in the next 12 months, next June and December 2024, 2 installments will become due. Therefore, out of 9 installment, 2 installments, that is 1 lakh rupee will be treated as short-term borrowings. Remaining 7 installments will be considered as long-term borrowings. So therefore, here 1 lakhs will be short-term borrowings. So remaining 7, that is 3,50,000 will be treated as long-term borrowings. So therefore, A is the correct answer. Next, case scenario 2. On 1st April 2019, sir, Black Limited received a government grant of 15 lakhs for acquisition of machine costing 50 lakhs. The grant was credited to the cost of the machine. Okay, the life of the machine is expected to be 10 years and estimated residual value at the end of the 10 years is 5 lakhs. The company charges depreciation on straight line basis. Okay, so company charges depreciation on straight line basis. Due to non-fulfillment of certain conditions, the company had to refund the grant on 1st April 2011. On 31st March 2023, Black Limited received certain impairment conditions and recoverable amount 28. Okay. And then 1st April 2024, the machine was exchanged. So it is kind of a mixture of asset related, that is accounting standard 10 PPE, accounting standard 28 impairment losses, and one more thing is that refund of grant AS12, all these mixed question. So see the first bit, 8th. What will be the impact of test of impairment on P&L account of the company? Simple. Sir, in impairment, we will compare the carrying amount with recoverable amount. So when impairment has been done, 31st March 2023, what is the recoverable amount? 28 lakhs. So first to find out the carrying amount on that date. So initially, if you see, sir, in this question, original cost of the asset is how much, sir? 50 lakhs, sir. 50 lakhs. And you received a government grant, 15 lakhs minus it because they credited to asset. So remaining asset 35 lakhs. And residual value 5 lakhs. So therefore depreciable amount 30 lakhs. And 10 years we need to provide depreciation. That means every year 3 lakhs per annum. So you purchased on 1st April 2019. That is 1920, 1920, 2021. 2 years, 6 lakhs is the depreciation. Because on 1st April 2021, after 2 years, the refund has been done. So therefore, on the date of refund, what is the carrying amount of the mission? So 50 lakhs minus 15, 35 lakhs minus first 2 years depreciation 6 lakhs. So it will be 29 lakhs. And now you are refunding the grant. So add back 15 lakhs. So therefore 29 plus 15. So it will be 44 lakhs. 44 lakhs. This is the revised carrying amount of the asset on 1st April 2021. Now again from 2021 to 22-23, 2 years you need to provide depreciation. On 44 minus residual value 5 divided by 8 because out of 10 years 2 years is already over. So 44 minus 5 lakhs divided by 8. The revised carrying amount is depreciated over the remaining life. So it will be 4.875. That you need to provide for 21-22, 22-23. So therefore 2 years. So 4.875 into 2, that will be 9.75. So therefore from 44 lakhs, if I reduce 9.75, the carrying amount is 34.25 on 31st March 2023. So on 31st March 2023, 34 lakhs 25,000 is the carrying amount of the asset and the recoverable value is 28 lakhs. So therefore carrying amount 34.25 lakhs and recoverable value 28. So therefore whatever the amount in excess of the recoverable value, that will be impairment loss. 6.25 lakhs is the impairment loss here. So the impairment loss 6.25 lakhs will be debited to P&L account. So 8th C is the answer. Now come to the 9th one. What will be the amount of profit or loss on exchange of the mission on 1st April 2024? Sir, on 1st April 2024, again, there is an exchange of machinery. Very, very important, sir. So on 1st April 2024, there is an exchange of machinery, sir. Now, what will be the loss or profit, sir? So on 31st March 2023, asset was, revalued to its recoverable value. Therefore, on 31st March 2023, what is the value? 28 lakhs. 28 lakhs. So therefore, 23-24, you need to provide depreciation on this 28 lakhs. And they said the revised useful life 4 years with a nil residual value. So 28 divided by 4. Therefore, 7 lakhs is the depreciation. So from 28, if I reduce 7, so it will be 28 minus 7. So it will be 21 lakhs. So 21 lakhs is what, sir? This is the carrying amount of the asset on 1st April 2024. And we exchanged it for a cash of 2 lakhs, new mission 18 lakhs. So therefore cash account will be debited 2 lakhs, new machinery 18 lakhs, old machinery 21 lakhs. So therefore what is the loss here? 1 lakh. So 1 lakhs is the loss of 1 lakh. So because the carrying amount of the asset 21 lakhs, we exchange it for 20 lakhs because 2 lakhs cash, new mission 18 lakhs. So that's the answer, 1 lakh. What will be the carrying amount of the machinery as on 31st March 2021 after charging depreciation? So that means he is asking initial, sir. Actually 50 lakhs, no, sir. Grant 15 lakhs, sir. 35 lakhs, sir. 35 minus residual value 5, sir. So 30 lakhs divided by 10 years. So 2 years depreciation if you provide 6 lakhs, sir, no, sir. So 29 lakhs is the answer. So 10th bit D is the answer. That is the carrying amount after depreciation. What will be the amount of depreciation to be charged on the machinery for the year ended 31st March 2022? So 31st March 2022, what will be the depreciation you are going to provide? So see sir, 4.875, sir. Because see, 50 lakhs is the value of the machinery. 15 government grant we received. First 2 years 6 depreciation. So it will be 29. Later on refund happened. 15 we should add back. Now it will be 44. Minus 5 is the residual value divided by remaining life 8 years. So therefore 4.875. So therefore 4,87,500 is the depreciation for the year 31st March 2022. Now come to the case scenario 3. See, case scenario 3 is entirely based on accounting standard 22, that is deferred tax assets. Following particulars are stated in the balance sheet of the Star Limited as on 31st March. See, deferred tax assets 1,20,000, deferred tax liabilities 2,10,000. So now they are asking us, so to calculate the, see here, what the following transactions are reported 23-24. Depreciation as per accounting records, as per income tax records. Interest paid, accounted in books on accrual basis, but paid on 15th May 2024. That means before due date only you paid. So that is also allowed as per the Income Tax Act, Section 43B. Employer PF contribution expenses disallowed for tax purpose in 22-23, but allowed in the year 23-24. Okay. Unamortized preliminary expenses as per tax records. Donation 70,000, tax record 20%. Okay. Tax rate 20%. Now what they are asking, what would be the value of reversal of deferred tax asset as on 31st March 2024? Already in the beginning there is a deferred tax asset of 1,20,000. Out of this 1,20,000, which one is giving reversal of DTA? I think reversal of DTA is this one. Employer PF contribution expenses disallowed for tax purpose in the 23-23 but allowed in the year 23-24. Therefore 82,000 into 20%. So 82,000 into 20%, that will be 16,400. I think reversal of DTA. This is the answer. First thing. Second, what is the permanent different item as per AS22? Donation is the permanent difference. Next, what would be the value of deferred tax assets as on 31st March 2024? So deferred tax assets value as on 31st March 2024. Actually, this is very good. First, what is the deferred tax asset opening? 1,20,000, sir. So 1,20,000 is the opening deferred tax assets, sir. Opening deferred tax assets. And they're asking what is the deferred tax asset as on 31st March 2024. And during the year there is a reversal of deferred tax asset, that is 16,400 because of PF, employer PF. Okay. And what are the items which is giving to deferred tax assets? See here. Interest paid will not give because it is also allowed as per the income tax. But unamortized preliminary expenses as per the tax, this is going to give deferred tax asset. So therefore 20,000. So 20,000 will be added. So therefore here 1,20,000 minus 16,400 plus 20,000. So therefore 1,40,000 minus 16,400. So 1,23,600 is the answer, sir. So C is the correct answer. Next, what will be the value of deferred tax liabilities as on 31st March 2024? So what is the opening balance of deferred tax liability? 2,10,000. Okay. So 2,10,000, 2,10,000 plus what items are giving deferred tax liability? Reversal. See, if you see the, as per accounting records 12 lakhs, as per income tax records 18 lakhs. So we provide excess depreciation as per the tax record 6 lakhs, which give rise to deferred tax liability. So therefore 6 lakhs into 20%, that will be 1,20,000. So it will be 3,30,000. So I think, so B is the correct answer. So okay. So this is quickly I solved in the MCQ. See, here and there will be some mistakes based on the assumptions. So I took it. So, and in the, I want to solve it very quickly. So I solved entire MCQ in 20 minutes. So that's why. So maybe some opinions differences will come. So please, I'm giving it as a disclaimer. Okay. Based on that, don't judge me. And come to the second part, sir. The second part, I think, sir, overall paper, if I give 10 out of this, I think 7. So I think it is moderate paper, so moderate paper. So I'm not saying it is very difficult, but I'm not saying at the same time very easy also. So it's an average moderate paper. MCQs, I think even with the minimum preparation, I think you can answer at least half of the MCQs. Okay. Second case study, I think that asset is quite little bit difficult only. Remaining, I think you can easily manage. And see the questions. XYZ, see the first question is relating to AS 20. That is computation of EPS, sir. Basic and diluted EPS. Sir, this question is very, common, sir. It is there in the accounting standard 20. So it is not at all, a difficult question here. So very simple question only. This question basically a straightforward question. So I can say that. This easily you can solve. Now the second question, sir. Operating lease, finance lease. Again, accounting standard 19 question. Sir, is there any difficult point in this question? Again, I mean to say there is nothing. Everything is same. So straightforward question as they have given in the from the AS 19. And next question, accounting standard 15, sir. I think most of the students have not done accounting standard 15, but surprisingly they have asked the difference between deferred contribution plan and defined benefit plan. I like this. So people should know at the end of the day, concept is more important. Now calculate the deferred tax liability asset. This is also very straightforward question, easy question only. Now see, here I think the gift of the paper I can say is that internal reconstruction question. And this question straight away the same question, sir. It is not at all, difficult as well as not at all different question. So 14 marks they have given to you. So just like that. So see this question. So it was decided to reorganize the capital structure. So same question. So they have given the balance sheet. See these type of questions are there in the study material also. Study material also, this type of question is there. Exactly this type of question. So equity share capital, preference, and reserves and surplus, long-term borrowings. So here uncalled capital is to be called up in full, and other fully paid up equity shares reduced to 5 per share. So subdivision, and the preference shareholders will accept 5% reduction. Reduction of 2.5 share. And this question is there. In exchange, the rate of dividend is to be increased to 9%. Okay. Preference shareholders will forego their claim of dividend for 1 year. One equity share of 5 each is to be issued for the remaining arrears of dividend. Same. X holds 10% debentures, 2,50,000 is also creditor for 50,000. He agreed to cancel 50% of his debt, including interest on debentures, pay 20,000 to the company and receive new. This type of adjustment is quite similar, sir. If you solve study material question, sir, this question straight away you can solve, sir. Okay. The remaining claim of debenture holders, including outstanding interest, is reduced to 60%. This point is also easy. The tax liability settled at 1,20,000. Market value of non-current investments given. So everything very simple. So this question easily you can solve, sir. Journal entries, and also prepare a note to show the revised capital structure of the company after completion of the scheme. Revised capital structure. So they are not asking the entire balance sheet, sir. Only the revised capital structure. So you need to prepare the share capital. So this question, and this question is 29, sir. Straightforward question, sir. This question is very, I mean, famous question. 2.5%, 4.5%. So they are given you different due dates. So which one has crossed the due date? So based on that, you need to remaining period. What is the remaining period of warranty? Based on that, you need to create the provision, sir. This question also you can find in AS 29. So very simple, straightforward question, sir. So this question easily, those who solved AS 29 study material or previous exam questions, you can answer this question quite simply. And then given below are the extracts of the balance sheet of BGH. So they have given the balance sheets. Again, operating activities, financing activities, this time cash flow statement, I don't know. So those who done the cash flow statement, so I think they are very happy, because one MCQ framed on cash flow statement, at the same time 7 marks asked. So understand the importance of cash flow statement. Okay, very, very important. And that too, this is very straightforward question. Operating activities, financing activities, 7 marks. They are also very simple question in the cash flow statement. So if you done cash flow statement internal reconstruction itself, you will get around 30 marks. So internal reconstruction 14 marks, this cash flow statement 7 plus there I think 10 marks. So straight away 25 to 30 marks you will get from these two chapters. And following is the summarized balance sheets of Light and Bright. I think this is this question is relating to, so a company Rainbow Limited is formed. So this time, sir, from amalgamation they have asked one question, and at the same time internal reconstruction also they have asked. So realization account, equity shareholders account in the books of Light and Bright Limited. So I think it is like in the study material there is a question called K Limited, L Limited, like this one question is there. So similar to that question, sir, the easy part is that they're asking transfer books. So the transfer books, you can easily close it through realization account. So other information also, new companies formed to acquire the assets and liabilities of both the companies. Assets were acquired at book values except land and building of Light Limited, which is revalued at 62 lakhs. Okay. Other assets of Bright Limited are obsolete and scrapped and sold for 50,000 by Bright Limited itself before acquisition of assets and liabilities by Rainbow Limited. Okay. That means even before acquisition, some transactions happened. Some assets are sold by the transfer company. Remaining assets are acquired by transferee company. Now, purchase consideration also sees here, Light Limited, Bright Limited will issue 80,000, 64,000 equity shares of 100 respectively of new company. So therefore, Rainbow Limited, in lieu of the purchase consideration due to them. So straight away purchase consideration is also mentioned here. So they are asking us transfer books as well as the opening balance sheet of the new company. Okay. Opening balance sheet of the new company. And here one interesting point, sir, in study material similar to this one question is there. In that question also, sir, transferee company details are not known because it's a new company. Now they are acquiring Light and Bright. So therefore in the balance sheet, if any difference came, that will be treated as bank overdraft as far as the purchase consideration is concerned, I think. But here purchase consideration is given in the form of shares. So let's see. I think, but the question is very similar, sir. It is not, I mean, difficult question. If you start it, I think easily you can solve it, this question also. Okay. And then next one, balance sheets of Super and Clear Limited given, sir. What is this question? This question, I think, yeah, Super Limited holds 75% equity shares, consolidation since the incorporation. 25% trade receivables of Super Limited is due from Clear Limited. Intercompany owings. During the year, Super Limited sold inventory costing 2 lakhs to Clear Limited. That means intercompany transactions, sir, at a price of 15% above cost. The entire inventory remains unsold with Clear Limited. So very simple, sir. Sir, here Super Limited sold inventory to Clear Limited, sir. What is Super Limited? Super Limited is a parent entity, I think. Yes. So Super Limited is the parent entity because Super Limited acquired 75%. So when parent company sold goods to subsidiary company, what happens? Tell me. The profit is booked by parent company. So therefore from the parent company reserves, we need to eliminate this unrealized profit. That is from this 2 lakhs, whatever the unrealized profit is there, 15%. So because at a price of 15% above cost, costing 2 lakhs. So therefore 30,000 unrealized profit we need to eliminate from parent company reserves as well as from the stock. I think that is the only adjustments, sir. Remaining and all very easy. Even consolidation also, there is nothing, sir. Straightforward consolidation they have given, sir, with the subsidiary. So even if you have a little bit knowledge of the consolidation, easily you can add all the assets and liabilities. Nothing great. So I think, so next, sixth question A. So see, this question related party transaction, sir, again. So this question is also very simple. And Accounting standard 18 related party transactions questions they have asked here. So little bit of knowledge of the reported related party. I think you can done this. And the next question is, so I think shut down the business with immediate effect. That is going concern assumption is affected. So if the going concern is not good, then how balance sheet will be prepared, P&L account is prepared. And this question is also framework chapter. I think this question is also a number of times they have asked it, sir. 1 or 2 times they have asked this question. So nothing great. And buyback. So this time they have asked only 4 marks question from buyback. 20% of the equity capital. Buyback is as per the provisions, and also pass the resolution. So you are required to pass the necessary journal entries. Right away, journal entries you have to pass. And independent branch they have asked it, sir, this time. So no dependent branches. So those who left the branch accounts, not at all a problem. So straight away 6 marks only came from the branch accounts, that to independent branches. So it is like normal accounting only you can do. So very simple. So this type of questions are there in the study material. Easily you can answer. So that's it, sir. Sir, overall, my point of view, sir, if you ask me, paper was very manageable, sir. Moderately difficult. And those who prepared well, it is very easy, sir. And those who averagely prepared, it's a moderate. But I don't think so it is difficult, sir. This paper easily you can manage. And those who prepared well, definitely they are going to give the get the exemption. So thank you, students, for this. This analysis I have made to you to, give you the value benefit. And in the process of doing it very quickly, so I might have taken some assumptions here and there. So maybe these are different from the suggested answers which is given by ICI. Hope you bear. So thank you so much.